The story doesn't begin with a crash. It begins with a feeling subtle at first, almost easy to ignore. In the early months, nothing looks broken on the surface. The listings are still there. The open houses are still scheduled. Agents are still smiling in photos, standing in front of perfectly staged homes under bright California skies. But something underneath has already shifted. For years, California's housing market moved with a kind of unstoppable force. Prices didn't just rise, they accelerated. From Los Angeles to San Diego, from the Bay Area to inland cities once considered affordable, the pattern was the same. Demand overwhelmed supply. Buyers stretched their budgets, then stretched them again. Homes sold in days, sometimes hours. Offers came in far above asking. It wasn't unusual to see bidding wars where logic no longer applied. That momentum built a belief, not just among investors, but among ordinary buyers. A belief that prices would keep rising, that waiting meant losing, that ownership, at any cost, was better than being left behind. It became less about timing the market and more about surviving it. But markets don't move on belief alone, they move on pressure, and pressure slowly was building. The first cracks didn't come from falling prices, they came from affordability. By the time the market reached its peak, the gap between income and home prices had stretched to a level that no longer made sense. Monthly payments weren't just high, they were historically extreme. Even dual-income households began to hesitate. First-time buyers, once the backbone of demand, started to disappear. At first, this didn't show up in headlines. Sales slowed quietly. Homes took a little longer to sell, a week instead of a weekend, then 2 weeks, then longer. Sellers, used to immediate offers, started to feel something unfamiliar, uncertainty. And then came the second layer of pressure, interest rates. As borrowing costs rose, the math changed overnight. A home that felt barely affordable at one rate became unreachable at another. Buyers didn't just lose purchasing power, they lost confidence. The same people who once rushed into bidding wars began stepping back, recalculating, waiting. This is where the shift becomes visible, but still not fully understood. In cities like San Jose and San Francisco, where prices had climbed the highest, the reaction was immediate. Listings began to pile up. Price cuts became more frequent, not dramatic at first, but consistent. A reduction here, another there, sellers testing the market, then adjusting when it didn't respond. Further south, in Los Angeles and Orange County, the change moved more slowly, but it followed the same direction. Inventory grew, demand softened. The balance that once favored sellers began to tilt. And then there are the inland cities, places like Riverside and Sacramento. These markets had seen some of the fastest growth during the boom. Buyers priced out of coastal areas moved inland, pushing prices higher at a pace that outstripped local incomes. For a time, it worked. Migration supported demand. But when the broader market slowed, these areas felt the impact more sharply. Because unlike coastal cities, where high incomes can sometimes absorb shocks, inland markets depend on a more fragile balance. When affordability breaks there, it breaks quickly. By the middle of the shift, the numbers begin to tell a clearer story. Sales volumes decline, not slightly, but meaningfully. Fewer transactions signal a deeper issue. Buyers and sellers no longer agree on price. One side still anchored to past highs, the other adjusting to new realities. This gap creates friction, and friction slows everything down. It's in this slowdown that the market reveals its true condition, not through dramatic headlines, but through absence, fewer offers, empty open houses, listings that linger. For sellers, the experience changes first. The strategies that once worked, setting a low asking price to spark a bidding war, holding firm on terms, expecting quick closes, begin to fail. Homes sit. Feedback becomes cautious. Buyers point out flaws they once overlooked. For buyers, the power dynamic shifts. Negotiation returns. Contingencies come back into play. Inspections matter again. The urgency fades, replaced by patience. But even at this stage, many still don't call it a downturn. The word crash feels too strong, too sudden. What's happening is slower, more complex. A recalibration, a correction, terms that soften the reality. Yet the underlying forces continue to build. Because housing markets are not just about buyers and sellers, they are connected to broader systems, employment, credit, investment behavior, and in California, these connections run deep. The tech sector, for example, plays an outsized role, especially in the Bay Area. During the boom years, rising stock values and strong compensation packages fueled housing demand. But when volatility enters that system, through layoffs, reduced hiring, or declining equity values, the impact extends beyond offices and into neighborhoods. A slowdown in one sector doesn't cause a collapse on its own, but combined with affordability pressures and rising borrowing costs, it adds weight to an already shifting market. This is how turning points form, not from a single event, but from layers of change that begin to align. By late stage, the mood is noticeably different. Conversations shift. Instead of asking how high prices can go, people begin asking how far they might fall. Media coverage changes tone. Analysts revise forecasts. Uncertainty replaces confidence. And yet, even here, the full picture isn't visible. Because what's happening across California is not uniform. Some cities resist longer, others adjust faster. Local dynamics, employment, supply constraints, migration patterns create variations that mask the broader trend. But beneath those differences, the direction is the same. Momentum has slowed, demand has weakened, and the assumptions that once drove the market are being questioned. This is the point where a cycle transitions, not fully collapsed, but no longer expanding, balanced on the edge between what was and what comes next. The breaking point is not a moment, it's a phase. And in California, that phase has already begun. The shift doesn't announce itself all at once. It deepens quietly, then all at once feels undeniable. What began as hesitation, longer listing times, fewer offers, now turns into something more concrete. Prices, once held firmly in place by expectation, begin to move. Not sharply at first, not dramatically, but consistently. In the early phase of decline, sellers resist. They anchor themselves to recent sales, to peak valuations, to the memory of what their home should be worth. Listings enter the market at yesterday's prices, carrying yesterday's assumptions, but the response is different now. Buyers don't stretch the way they used to. They don't compete the way they once did. They watch, they wait. And when offers come in, they come in lower. This is where the standoff begins. Sellers hold, buyers hesitate, transactions slow further, but time more than anything begins to apply pressure. Mortgage payments continue, property taxes don't pause, life circumstances, job changes, relocations, financial strain don't wait for the market to recover. Eventually, adjustments happen. The first reductions are small, almost symbolic, a price trimmed just enough to signal flexibility, but not enough to redefine value. When that doesn't work, the cuts become larger, more visible, more frequent. Listings that once stood untouched now carry a history: original price, first reduction, second reduction, each one a marker of shifting expectations. And this is when the data begins to change in a way that can't be ignored. Across California, median prices start to edge downward, not everywhere at the same pace, but in enough places to signal a pattern. Sales data, which once reflected aggressive bidding, now reflects negotiation. Closed prices come in below asking. Concessions reappear, repairs, credits, terms that favor the buyer. The narrative shifts from strength to adjustment. In the Bay Area, the transition is especially visible. Cities like San Jose, where valuations had reached extraordinary levels, begin to show clear signs of reversal. Inventory builds faster than it clears. High-priced homes sit longer, even as sellers reduce expectations. The tech-driven demand that once pushed prices upward now feels less certain, less immediate. San Francisco follows a similar path, though shaped by its own dynamics. Urban demand, once fueled by proximity and lifestyle, weakens as remote work reshapes priorities. Some buyers look outward, toward more space, more affordability. Others step back entirely, waiting for clearer signals. Further south, Los Angeles presents a more gradual shift, but the direction remains consistent. The scale of the market creates a kind of inertia, but even there, the change becomes visible in segments. Luxury properties, once insulated by wealth, begin to see softer demand. Mid-range homes, dependent on financing, feel the weight of higher borrowing costs more directly. Orange County, long defined by strong demand and limited supply, begins to show similar patterns. Price reductions increase, listings accumulate. The balance shifts, not abruptly but steadily. But it is in the inland regions where the change accelerates. Cities like Riverside and San Bernardino had experienced some of the fastest growth during the boom. They absorbed demand from buyers priced out of coastal areas, creating a surge that pushed values upward at a pace disconnected from local fundamentals. For a time, migration sustained the momentum. But when affordability tightened across the state, that migration slowed. And when it slowed, the vulnerability of those markets became clear. Listings in these areas begin to rise sharply. Sellers who bought near the peak find themselves in a different position, competing not just on price, but on urgency. Some need to sell, others want to exit before conditions worsen. The result is a kind of cascading adjustment, where one reduction leads to another and comparable sales begin to reset lower. Sacramento, once seen as a relative safe haven, begins to follow a similar trajectory. Its appeal, proximity to the Bay Area combined with lower costs, had driven strong growth, but as the broader market cools, even that advantage weakens. Buyers who once moved quickly now pause, the inflow slows, prices respond. This is how a statewide shift takes shape, not through a single collapse, but through a network of local adjustments that begin to align. By this stage, the numbers reflect what the market is already feeling. Year-over-year comparisons begin to show declines, not extreme, but meaningful enough to alter perception. The idea that prices always rise is no longer supported by recent data. And perception matters. Because housing markets are driven as much by expectation as by necessity. When buyers believe prices will be higher tomorrow, they act quickly today. But when they believe prices might be lower, urgency disappears. This change in behavior reinforces the trend. Open houses grow quieter, not empty, but less crowded. Conversations shift from competition to caution. Buyers ask different questions now, not how much over-asking they need to offer, but how much room there is to negotiate. Sellers adjust in response, but not all at once. Some move quickly, recognizing the change and pricing accordingly. Others hold, waiting for a rebound that doesn't come. This creates a split within the market, homes that sell because they meet current conditions and homes that linger because they don't. Over time, the lingering listings become more visible. They accumulate, they shape perception. A buyer scrolling through listings doesn't just see options, they see time on market, price histories, signals of weakness. And those signals influence decisions. Investors who once played a significant role in driving demand begin to pull back as well. The calculus changes for them even faster. Rising costs, combined with uncertain appreciation, reduce the appeal of new purchases. Some shift strategies, others exit entirely. This removes another layer of support from the market. At the same time, new supply continues to enter, not at the pace of past decades, but enough to matter in a slowing environment. Developments that were planned during the boom reach completion in a different market than the one they were designed for. Builders adjust pricing, offer incentives, attempt to maintain momentum. But incentives signal something important. They signal that demand alone is no longer enough. And this is where the pressure becomes visible across all levels of the market. From high-end properties in coastal cities to entry-level homes in inland regions, the pattern repeats. Prices soften, negotiations expand, time stretches. Still, it doesn't feel like a crash in the traditional sense. There is no single moment of collapse, no sudden drop that defines the shift. Instead, it is a steady, accumulating change that becomes harder to ignore with each passing month. The data confirms it, the experience reinforces it, and the narrative begins to catch up. Headlines shift from optimism to caution. Analysts revise projections. Discussions turn toward risk, toward downside scenarios, toward the possibility that this is not just a pause, but a transition into a different phase entirely. And within that phase, the idea of a top 10 emerges, not as a ranking of success, but as a reflection of vulnerability. Because not all cities face the same level of exposure. Some carry higher valuations relative to income, others depend more heavily on migration flows. Some are tied closely to volatile industries. Others expanded too quickly during the boom. These factors begin to define which markets adjust first and which adjust most. The list is not static. It evolves as conditions change, but the underlying logic remains consistent. Where the imbalance was greatest, the correction tends to be sharper. And as California moves deeper into this phase, those imbalances are becoming clearer. The breaking point, once a distant concept, is no longer theoretical. It is visible in the numbers. It is visible in the behavior. And most of all, it is visible in the cities themselves, each one telling a slightly different version of the same story. A story where pressure has turned into movement. And movement has begun to reshape the market. By the time the market reaches this stage, the shift is no longer subtle. It is no longer something that can be explained away as seasonal slowdown or temporary hesitation. The pattern has held for too long. The direction has become too consistent. What was once a soft adjustment now begins to take on weight. Prices are no longer just easing, they are stepping down in visible increments. In many neighborhoods, comparable sales start resetting at lower levels, not dramatically at first, but enough to change expectations. A home that would have closed at one price 6 months earlier now sells for less, and that sale becomes the new reference point. Appraisals follow, lending adjusts. The entire framework that once supported higher valuations begins to shift downward. This is where momentum, which once pushed prices up, begins to work in reverse. Sellers who might have waited earlier now face a different calculation. Waiting no longer guarantees a better outcome. In some cases, it guarantees the opposite. Listings that linger too long risk becoming stale, and stale listings attract lower offers. The longer a property sits, the more negotiating power moves to the buyer. And so, behavior changes again. More sellers begin to act with urgency. Some are responding to financial pressure. Adjustable-rate mortgages begin to reset at higher levels. Monthly payments increase in ways that were not anticipated when the home was purchased. What once felt manageable begins to feel strained. For households already operating near their limits, the shift is immediate. Others face external pressures, job changes, relocations, or income disruptions. In stronger markets, these situations can be absorbed. Homes sell quickly enough to resolve the transition, but in a slowing market, time becomes a risk. Delays carry cost. This is how forced selling begins to enter the picture. Not as a wave, not all at once, but as a growing presence. One listing here, another there, properties priced not just to compete but to move. These listings don't wait for the market, they meet it where it is or sometimes below it. And when they close, they pull comparable values down with them. In inland cities like Riverside and Stockton, this effect becomes more pronounced. These were markets that expanded rapidly during the boom, fueled by affordability and migration. But rapid growth often carries hidden fragility. When demand slows, there is less support to hold prices in place. Inventory rises faster here, days on market stretch longer, price reductions become deeper. Sellers who entered at peak valuations find themselves in increasingly difficult positions. Some hold, hopping for stabilization. Others act quickly, accepting losses to avoid greater ones later. The result is a feedback loop. Lower sales create new comparables justify lower offers, Lower offers lead to more reductions. Each step reinforces the next. In the Central Valley, cities like Fresno and Bakersfield begin to reflect similar dynamics. These areas, long valued for relative affordability, had seen prices rise to levels that stretched local incomes. When the broader market shifts, that stretch becomes harder to sustain. Buyers retreat first, then investors. What remains is a thinner pool of demand facing a growing supply. Even in stronger regions, the pressure builds. In Los Angeles, the scale of the market slows the pace of change, but it doesn't prevent it. Certain segments begin to show clear weakness. Homes that depend heavily on financing feel the impact of higher rates most directly. Sellers who once expected multiple offers now adjust to fewer showings, longer timelines. In higher-end segments, a different kind of pressure appears. Wealth can insulate, but it does not eliminate risk. As financial markets fluctuate and economic uncertainty grows, even high-income buyers become more cautious. Luxury listings sit longer, price adjustments become more visible. The Bay Area, once the engine of rapid appreciation, continues to recalibrate. San Jose and surrounding areas reflect the compounded effects of tech sector volatility and affordability limits. When hiring slows and equity values fluctuate, demand softens quickly. Here too, forced selling begins to appear, not widespread, but enough to matter. Employees who once relied on stock-based wealth face a different reality. Some choose to liquidate assets, including property, to rebalance. Others delay decisions, adding to the slowdown. And through all of this, a psychological shift takes hold. The belief that defined the previous cycle, that prices would continue rising, has been replaced, not by panic, but by caution. Buyers approach the market with a different mindset. They expect negotiation, they anticipate further declines, and because of that, they act more slowly. This behavior extends timelines even further. Open houses become quieter still. Agents adjust strategies, focusing less on urgency and more on positioning. Marketing changes tone. Instead of emphasizing competition, it emphasizes value. But value, in a declining market, is difficult to define. Because what feels like a discount today may look like an overpayment tomorrow. This uncertainty keeps many buyers on the sidelines. And as they wait, supply continues to build. Not just from new listings, but from accumulation. Homes that didn't sell last month remain on the market this month. Each unsold property adds to the total, creating a sense of abundance that didn't exist before. This shift from scarcity to surplus is one of the most important turning points in any housing cycle. Because scarcity drives urgency. Surplus drives patience. And patience slows everything down. At this stage, the top 10 cities in trouble becomes more than a headline. It becomes a pattern that can be observed. These are the cities where multiple risk factors overlap, where price growth outpaced income by the widest margins, where demand relied heavily on migration or investor activity, where affordability was already strained before rates began to rise. In these places, the adjustment is not just visible, it is accelerating. Price charts show clearer downward trends. Inventory levels climb higher relative to demand. Sales activity declines more sharply. The gap between asking and closing prices widens. And perhaps most importantly, sentiment shifts more quickly. Local conversations reflect it. Agents speak more cautiously. Sellers express concern. Buyers feel less pressure to act. The market in these areas begins to move with a different rhythm, one defined not by competition, but by recalibration. Still, it is not uniform. Even within the same city, outcomes vary. Well-priced homes in desirable locations continue to sell, though often at adjusted values. Overpriced or less competitive properties struggle. This creates a fragmented market where conditions depend heavily on specifics. But fragmentation does not stop the broader trend. Because the underlying forces, affordability, financing costs, economic uncertainty continue to apply across all segments. And as they persist, the pressure deepens. More sellers adjust, more buyers wait, more transactions close at lower prices. Each step small on its own, but together forming a clear direction. By now, the idea of a soft landing feels less certain, not impossible, but harder to sustain in the face of accumulating evidence. The market is not collapsing in a single moment, but it is declining in a way that reshapes expectations. And expectations, once changed, are difficult to reverse. This is the stage where cycles either stabilize or accelerate further, where confidence can begin to rebuild or continue to erode, where the difference between correction and deeper downturn is decided not by a single factor, but by how all the pressures interact. In California, those pressures are still building. And in the most vulnerable cities, the effects are becoming harder to contain. The breaking point is no longer approaching. It is unfolding. By the time the market reaches this final stage, the question is no longer whether conditions have changed. That part is already clear. The real question becomes how far the shift will go and what remains when it settles. Because every housing cycle, no matter how gradual or abrupt, eventually arrives at a point where the adjustment forces a new reality. Prices don't fall endlessly. Demand doesn't disappear completely. Instead, the system searches for balance again. But the path to that balance is rarely smooth. In California, that path is shaped by everything that came before it. Years of rapid appreciation created expectations that are slow to unwind. Buyers who stepped back earlier now watch more closely. Sellers who resisted adjustments now face harder choices. And across the market, the space between those two sides, the gap between what sellers want and what buyers are willing to pay, becomes the defining feature of this phase. That gap does not close quickly. It narrows through pressure. By now, price declines are no longer isolated to specific neighborhoods or segments. They are visible across broader regions, not uniformly, not equally, but enough to establish a trend that is difficult to ignore. Monthly data reinforces it. Quarterly comparisons confirm it. Even year-over-year numbers begin to reflect a clear downward direction. And with that clarity comes a different kind of behavior. Sellers, increasingly aware of the trend, begin to act earlier. Instead of listing high and adjusting later, some price more realistically from the start. Others, especially those under pressure, price aggressively to secure a quick sale. This creates a new layer of competition, one defined not by who can offer more, but by who is willing to accept less. That competition accelerates movement. Homes that might have lingered before now attract attention because they represent perceived value. Buyers, still cautious, become selective but not absent. They engage when pricing aligns with their expectations of where the market is heading, not where it has been. This is how a new equilibrium begins to form, through alignment between adjusted expectations on both sides. But the process is uneven. In the most vulnerable cities, the ones where price growth had stretched furthest beyond local fundamentals, the adjustment continues to run deeper. Inland markets, already under pressure in earlier stages, now face the full weight of the shift. Declines there are more visible, more consistent. Inventory remains elevated. Time on market stays extended. For some sellers in these regions, the situation becomes a matter of timing rather than price. The goal shifts from maximizing return to minimizing loss. This is where the emotional dimension of the market becomes most apparent. Decisions are no longer driven by opportunity, but by necessity. And necessity changes behavior quickly. At the same time, stronger markets begin to show early signs of stabilization, not recovery, but resistance. Coastal cities with limited supply and higher income levels do not escape the downturn, but they absorb it differently. Price declines occur, but at a slower pace. Demand, while reduced, does not vanish. This divergence creates a more complex picture. California is no longer moving as a single, unified market. It is fragmenting into tiers, areas that adjust quickly, areas that adjust gradually, and areas that begin to stabilize sooner. But even within that fragmentation, the broader cycle remains intact. Because stabilization does not mean reversal. Not yet. The conditions that drove the downturn, affordability constraints, higher borrowing costs, economic uncertainty, do not disappear simply because prices have declined. They ease slowly, if at all, and until they do, they continue to shape behavior. Buyers remain cautious. Lenders remain selective. Investors remain restrained. This keeps upward pressure limited, even as downward pressure begins to ease. And so the market enters a quieter phase. Transactions continue, but without urgency. Prices move, but in smaller increments. Volatility gives way to something more measured, a period where data matters more than emotion, where decisions are based less on fear of missing out and more on careful evaluation. This is the phase where the market resets its foundation, where prices, incomes, and financing conditions begin to reconnect in a way that is sustainable. It does not happen all at once. It happens gradually through thousands of individual decisions that together redefine value. And in that process, new opportunities begin to emerge. Not the kind driven by rapid appreciation, but the kind rooted in stability. Buyers who were previously priced out may find entry points again. Long-term investors, less concerned with short-term fluctuations, begin to reevaluate. Even developers, after pulling back, start to plan again, but with different assumptions. Still, the memory of the shift lingers. Because cycles leave behind more than data, they leave behind perspective. The experience of rapid rise, followed by gradual decline, changes how participants view the market. It tempers expectations. It introduces caution where there was once confidence, and it reshapes the narrative that will guide the next phase. In California, that narrative is still being written. The cities that adjusted fastest will carry lessons about volatility. The ones that held steadier will reflect the importance of fundamentals, and together they will form a new map of risk and resilience across the state. The top 10 cities in trouble may not remain the same over time. Some will stabilize, others may face continued pressure, but the concept itself of identifying where imbalance is greatest will remain relevant. Because imbalance is what drives every cycle. Too much demand chasing too little supply. Too much optimism chasing too little caution. Too much price growth chasing too little income support. And when those imbalances correct, they do so through phases like this one. Not a single moment of collapse, but a sequence of adjustments that, taken together, reshape the market. By the end of this phase, California's housing landscape does not look the same as it did at the peak. Prices are different, behavior is different, expectations are different. But the market is still there, still functioning, still adapting, still moving forward. Because housing markets do not end, they evolve. And what feels like a breaking point in one moment becomes, over time, a turning point in a much longer story. A story defined not just by rise or fall, but by the constant process of finding balance between them.